We've just seen the hottest US CPI inflation print in 40 plus years. This has of course ratcheted up pressure on the Federal Reserve, potential discussions about a full 100 basis point interest rate hike in the upcoming meeting. Today we're going to discuss all of the numbers, we'll dive into the potential implications for the markets and what to make sense of it after what was a milestone US inflation print.
Sit back and enjoy.
And so here we have it, just some of the numbers. As we dive into it, it was a record print. It definitely was far hotter than all of the analysts and economists' expectations. And of course, yes, we are coming at you live from Spain. Our first video officially on tour. Still getting the set right. Of course, there's a few things to optimize. But this was a record and milestone print, so I thought it was worth bringing it to you hot off the press. As we can see here, the numbers, CPI print increased 1.3% month on month, 9.1% year on year. Analyst expectations was about 8.8%, so it was definitely far hotter than was anticipated. As we can see here, the increase was broad-based. Obviously, initially, 18 months ago, when inflation narrative started up, it was quite narrow in terms of its breadth, but we've started to see it spreading out. Gasoline, shelter, food being the largest contributors. Groceries are up significantly over the past 12 months. Energy index was a significant contributor, nearly half of all the items increased. And this is worth noting because, of course, we know that gasoline has been rising, 11.2%. We know that energy prices have been rising, exacerbated by supply chain shortages, as well as everything, of course, playing out in Europe. But it is worth noting is that over in the US, gasoline prices have been coming down over the past 30 days. So looking forward to this upcoming month's print, it'll be fascinating to see the effect of that on the broader headline number. We can also see the food index rose 1.0% in June. We all know about the rising prices of groceries. We're all seeing it when we head down to the shops, the lettuce shortages and everything else playing out on that front. What is noteworthy here, core inflation has dropped not just this month, but over the past 3 months. Of course, core inflation strips out the most volatile components, those food and energy components, and it's now below 6% for the first time in a while. Largest contributors were the indexes. Largest contributors were shelter, used cars, trucks, medical care, motor vehicle insurance. A lot of these, of course, are the domestic pressures over in the US markets. So it'll be interesting to see what happens flowing through from here. And we can see that here over the year-on-year basis. If we think about what the Federal Reserve and other central banks are looking to act on, of course, they're waiting to see peak inflation and to see a sustainable subsiding of those inflationary pressures. Initially, we thought potentially that may have happened in this month here. We saw an 8.5% peak, retraced back to 8.3%, waiting to see if that was the peak then, but we went back to 8.6%, and now this has blown expectations out of the water. We're at 9.1% now. So Federal Reserve, Jerome Powell, they highlighted that with their last meeting minutes, that they want to see this sustained downgrade rather than, of course, just acting month to month to month and being reactive. And so having a look here at a bit more of a refined discussion about everything that played out after that, traders up their bets on the pace of interest rate increases ahead. We know 75 basis points was the initial discussion. Now the market's potentially even pricing in a full 100 basis point interest rate hike. Obviously it's a lower percentage chance, but it's started considering that as well. And here's quite a good summary from James Knightley, ING's chief international economist. He stated, with supply conditions showing little sign of improvement, the onus is now on the Fed to hit the brakes via higher rates to allow demand to better match supply conditions. Of course, I've got to slow down that demand side, even though a lot of these inflationary pressures have originated from the supply side, the supply chain bottlenecks, obviously the shortages and everything else, but the recession threat is rising. And ultimately that pathway towards a soft landing is becoming narrower and narrower and narrower. Now, not everyone's saying it's impossible yet, but it's definitely getting more difficult. And this was quite an interesting article as well out of the AFR. We know that it's not just the Federal Reserve, but other central banks around the world. The Reserve Bank of Australia just raised 50 basis points, but other central banks are now rushing rates through as well. Most noteworthy, the Bank of Canada lifted its cash rate by a full percentage point. They did the 100 basis points. They're now at the 2.5% mark. But we also saw the Monetary Authority of Singapore, as well as the Philippine Central Bank as well. And of course, there's now discussions about what happens to the terminal rate. We know that with the dot plots, terminal rate was in those mid 3% mark, but with everything playing out, is this going to get higher? And ultimately, what's going to happen once we get to that more neutral rate? Will the Federal Reserve have to hike through that, even if it is potentially hiking into weakness? University of Michigan expectations, but it's worth noting that the UOM inflation expectations print last month did move markets. It was interesting to see that. Of course, it's not just about inflation in the here and now, but the expectations that are embedded into the society and the decision-making process as a result of that. This comes out later on in July. It's going to attract a fair bit of attention, but it's also worth noting as well that the dot plot itself, 3.4% was that neutral rate that was anticipated. Of course, potentially higher into 2023 before a natural retracement. We've seen a sustained yield curve inversion over this past period, with the near-term expectations higher than the long-run expectations now on the 2s10 spread. So this is going to be something that's very interesting to watch, but there's also a range of other discussion points as well. Where is peak inflation? How long is it going to take to reach that? What happens on the supply side to the supply side pressures? Of course, the Federal Reserve and other central banks discussions as well. We know that the Fed put is no longer in place, but what happens if we start to see significant weakness or potentially recessionary pressures rise? We've seen the slowdown start to come through in a few different economic data prints, whether it's on the retail side, the consumer confidence side. Of course, we talked about the inflation expectation discussion too, and the ISM on the manufacturing print. But what happens if we see sustained weakness coming through? And then ultimately earnings. Earnings season is upon us. We've seen a downgrade in terms of the price on the valuation side, but we so far have seen relatively resilient earnings expectations. But earnings season could be formative for not only direction, but also sentiment around the market. A big thank you for joining us. Drop in a comment, let us know your thoughts. Thanks for joining us, and for now, stay well, happy investing.